Hey everyone, thanks for joining me for this one. In today's video, I'm going to be talking about stocks I've been buying over the last few weeks in my $264,000 Wealthsimple dividend stock portfolio. I'm also going to be talking about one stock I've been adding a lot of in my RSP this year as well so far at the end of the video, and some other things in the market that have been interesting me as of late. So thank you guys for joining me. We're just going to jump right into this one. As you can see here, my portfolio has actually been pretty flat over the last couple periods here. In the last month, my Canadian portfolio is actually down about 1%. Going over to the US side, up about 1%. So not too much movement. And as you can see, not too much new money has been going to my portfolio over the last month, 6 weeks, just as I filled up my TFSA and I'm trying to get lots of my RSP contribution room used before the end of February as well to get a tax refund there. So hopefully now that February is almost over, it'll pick up a bit, but I haven't been using too much incremental capital in this portfolio. Lots of these buys have been through leveraging some of the cash accounts I already had in Wealthsimple, paired with the dividend income I've been getting in this account so far this year. Starting on the Canadian side, there's been 2 to 3 stocks I've been adding to here. Pretty reliable dividend paying stocks. Boring, some would even call. One has been Fortis. Fortis hasn't really had a good couple months. Looking even here in the last month, down 1.5%. Past 3 months here, down about 5%. I added about 10 shares of Fortis in that $52 to $53 range. I really like the dividend growth on this one, about 6% a year. And you're getting a nice starting dividend of about 4.3, 4.4% as well. A multiple on earnings of about 17 times. And this is a company with just a great track record. So it's one that I'm trying to build into a bigger position in this account. I have about $10,000 today. But one of the things about Fortis is I actually have some Fortis in some of my registered accounts. And I'm really trying to prioritize my registered accounts for more tax inefficient holdings. So over the next couple months, I'll probably move some Fortis out of that registered account and buy a big lump sum in this account if the price remains at these levels, to maybe move over some REITs or some royalty funds or some covered calls I still owned in unregistered accounts over, just to maximize the tax efficiencies of my holdings. But these buys I've been doing has actually just been incremental to Fortis as a whole, building the position larger and larger, as I really like getting that over 4% starting yield and adding to a stock that I know is going to continue to increase their dividend year in and year out. And I feel like I'm getting it at a bit of a discount as the broader market's been going up over the last 3 months. Obviously different sectors at play, but Fortis has kind of been stagnant to down. So I think it's a good spot, in my opinion, to or a good time rather, to build this one out a bit. Another stock I've been buying fits a similar mold. It's a stock that has a pretty good starting dividend yield and also has been increasing. It is TD Bank. TD Bank here, I'm getting a starting yield of right around 5% after their recent dividend increase here. And this one over the last 3 months has also been trailing down a bit behind the sentiment that interest rates may not be going down as fast as prior. And it's a really interesting dynamic going on with some of these banks, because when I started investing, when interest rates went up, the spread, the net interest margin went up for lots of these banks. So it's actually seen as a tailwind, a positive margin expansion for the banks. But now there's just a lot of fear that interest rates are too high. It's holding back lending and other things in the economy, maybe posing some consumer risk, some risk to mortgage books and credit quality and whatnot. But I believe the Canadian banks are really solid. Even within the Canadian banks, TD Bank's probably, in my opinion, one of the more solid ones. So buying at $80 a share when they're expected to do $8.50 in earnings per share this year, I feel like is a good long-term, a good position or a good time to get in from a multiple standpoint over the long term. They've been able to drive their earnings per share higher. I don't see in the foreseeable future why that's going to change. They're really an oligopoly, and the Canadian market, as immigration comes in and whatnot, continues to grow. There's only so many choices to go to for banks. So there's some disruptors like EQ Bank, some other smaller lending firms. But overall, I think that these banks will continue to grow, find ways to monetize their services. And buying right now at around 10 times earnings with the dividend growth history they have, it's another kind of boring stock. That's a core position for me that I'm continuing to buy into. Looking at my position right now in this account, similar to Fortis, have about $10,000. But I'd also say I Similar to Fortis, I have some of these shares in registered accounts, so looking to moving those over. But the 10, 15 shares I bought so far this month have been net incremental to my overall TD position across accounts. So 2 stocks there, both paying 4 to 5%, both paying growing dividends over time. Feel really good about increasing my equity stake in both of those positions. Now I'm going to go over to my US holdings a bit here. In the US, there's been a couple stocks I've been buying, or I should refer to them more as ETFs, because they all are ETFs, the stocks that I added to my portfolio. The first one was VPL. This is an international equity fund that owns stocks in the Pacific region. Taking a look at this stock over the last 5 years, it's been a bit of a wild ride. I'd say that about 70% of their geographical exposure is to Japan. So this is pretty much a Japan ETF, then a couple percent Hong Kong, couple percent Singapore, some of those other countries like Australia in that region. But this is really a way to get exposure to Japan, which is a really interesting market, diversifies me well across that region, away from North America, where probably 80%, 75% of my total portfolio exposure is. So even though long term this may not grow as much, it's really a strategic play just to better diversify my assets and where I have my investments to some degree. They have a really low management fee, under 10 basis points. One thing I don't like about these ETFs is the withholding tax on the dividend. So this stock pays a dividend yield of about 3.1% there. So I think I have to pay about 15% of that in withholding fees, which is about 45 basis points a year. Pairing that with the 8-9 basis point management fee, paying about 0.5% a year in net value to hold this one. Obviously, longer term would be great to be able to move all of these over to my RSP. I only have so much room in my RSP though. So for now, this is one that I'm living with in an unregistered account. I think I have bigger fish to fry in terms of some of my other royalty distribution stocks and whatnot in terms of prioritization in my RSP. The second one here is another ETF and similar strategy in terms of why I'm holding this one, just to more or better diversify away from the North American market. I'm not expecting for it to necessarily outperform, but this one is an emerging markets ETF, ticker VWO, in the US. This stock owns, or this ETF owns, a lot of exposure in Taiwan, China, as well as India's 20% equities in India, 7-8% in Brazil, and then 1 to 2% in smaller markets. Let's think Dubai and those kinds of countries as well. Saudi Arabia, I believe, is also 1 or 2%. So exact same state case as with VPL, just looking for baskets of stocks in these other regions that I have no exposure to without them. Probably will be pretty small positions overall across my portfolios, but ones that I think are important and just, in the future, give me more confidence in investing heavily in the North American market, knowing I have some of this exposure in other areas. In addition to that, pays a nice 3.5% dividend yield. Same pain point as VPL, where lots of that, or not lots of it, but about 50 basis points of that will go to withholding taxes each and every year, which is a bit annoying. So long term, once again, maybe one that I'd love to get in my RSP one day where I won't have to deal with that. But for now, I'm dealing with it just to get the exposure where I want it. Third ETF here is one I'm really excited about. I bought a ton of this in one of my other accounts too, from a stock I sold. I'll talk about that in a separate video. But it is the XLV, which is the S&P Healthcare Spider ETF here. This stock's up about 12% in the last year, but honestly, lots of that really has come in the last few months, all of it in the last 3 months actually. And in the last 5 years, this one's done really well, up 58%. So this ETF owns about 33% of their assets from pharmaceutical companies. Think companies like AbbVie, Amgen, those types of stocks, Eli Lilly. The one thing that it doesn't have, since it's a S&P 500 ETF, is lots of the European stocks like Novo Nordisk and whatnot in the healthcare space. I don't really get exposure to that, but it's 1/3 healthcare. It also has insurers like UNH, United Health Group, and lots of other insurance plays, along with Medtronic and other healthcare supplies providers, for lack of a better term. I really wanted to increase my exposure to the healthcare sector across my portfolios, but I'm not too familiar with the space. So I didn't want to go in, pick one pharmaceutical company and get smoked if they lose a patent or get a lawsuit or something like that. So I thought it would just be better to buy the entire sector. Long term, it seems like it's panned out pretty well. It doesn't pay a huge dividend, about 1.5%. So the withholding tax is about 20 basis points for me on top of the 7-8 basis points to hold the fund, I believe. So all in all, pretty low fee on this one. Not one I'll really look to move to a RSP, assuming I still have other higher priority ones to move there over time. But this is one strategically I'm really excited to add to the portfolio for the long run, just to continue riding that wave of the healthcare sector, since I'm really underweight that in the rest of my portfolio. Depending on, where this one goes, it's one I wouldn't mind adding more to. Obviously, it's on an absolute tear here in the last few months. So at all-time highs, would love for it to come down even more so I can buy a bit more. But this is one I'm going to look to continue to be focused on where opportunities, present themselves. Another space I've been really interested in over the last few weeks has been the restaurant space. So looking at some of my restaurant stocks here, we got QSR. QSR is a pretty big position for me here, about $15,000. It's done pretty well. It's held up pretty well, actually. It's been a bit rocky, but overall holding in there over about $100 a share, trading at about, I think, 22 times earnings, give or take. And I'm getting a nice dividend yield as well. I think this is in US dollars, so it's really about 3.5% dividend yield overall on an annual basis. For those of you who don't know, Restaurant Brands International owns stocks like Burger King, Tim Hortons, and Popeyes. They just reported earnings that I thought were pretty solid, a really strong beat on the Tim Hortons side of the business. And they announced a strategic review, or the outcome of their strategic review, where they're really looking to fuel restaurant growth over the next 3-4 years, which is really exciting. Lots of that coming in international markets, which should hopefully drive a lot of incremental stores and royalty income for the company across their brands here. So they had pretty strong earnings. Looking at some other stocks here, McDonald's actually went down slightly on their earnings, but bounced back pretty much immediately here. If I look at the last 3 months, you can see hit $300, went down into the 280s here after earnings, but back up to 293 a share for the most part, really close to all-time highs. Really expensive stock here. Don't own a ton of it in this account specifically. Starting yield of 2.1% on it, but they continue to increase that dividend every year. A couple other restaurant stocks worth noting here. Wendy's is a stock that I did a review on my channel about a year ago now, and it's really underperformed in the last year here, down about 20%. I remember being confused about this one. Really small company relative to some of the other fast food companies, just a $3.7 billion market cap. Lots of the other fast food royalty stocks, or franchise stocks rather, have multiple brands. Like Yum Brands has Pizza Hut and KFC and whatnot, whereas QSR, we just went over their brands. McDonald's is a standalone, and Wendy's is also a bit of a standalone, but significantly smaller. So they don't have the same scale in customer acquisition and across digital spend and whatnot. But what concerned me a lot about Wendy's when I reviewed them is they had a ton of debt. And despite having a lot of debt on the company, given their market cap, in my opinion, they doubled their dividend, which is now a whopping 5.5%. That's probably one of the higher ones in the entire fast food industry. I can't think of another one off the top of my head that's higher. And they talked about share buybacks in their capital allocation strategy, where they have tons of debt, they have tons of opportunity for reinvestment in fueling their digital growth, where they're behind some of their competitors, it seems, and other elements of their business. So it's just really interesting how much capital they're returning to shareholders, despite what seems like a really big opportunity for them to gain a lot of market share from Burger King and McDonald's in their home market, and especially internationally, where they barely have a presence. So really surprised just by the fact that they're paying out 5.5% dividend. They're buying back shares. This could be a growth stock, and priced as one if they allocated their capital to other areas and executed well with it. So I don't want to say I'm not surprised, but down 20% in the last year, obviously being crushed by the broader restaurant market, being crushed by the S&P. It's been a tough year for Wendy's. Would love to see them maybe change their capital allocation, get back to growth across their business and investing in the right things, given the state and the current development of this company, and see if they can really turn it around. But in the meantime, especially since they're technically competing with a couple of the other burger chains I own, I don't really mind them, you know, fumbling the bag a bit here in terms of their recent performance and where they're spending their or investing their capital. Another restaurant stock here, Shake Shack. Shake Shack up 76% in the last year. They crushed their earnings, up 40% in the last month alone. I think they went up about 30% on earnings day here. $4 billion market cap. So Shake Shack is now a bigger market cap than Wendy's, which will surprise lots of people. Transparently, I'm not super clear on if they own all of their restaurants or they also have a franchising model. So if they own all their restaurants, that would make a lot more sense how they got bigger than Wendy's. But they're definitely not there based off of their earnings. They're running about a break-even business right now, which honestly, for how fast they're growing revenue and how fast they're scaling, if you are a growth investor in the space, is not a bad thing. At least they're not losing money here or burning capital. I believe they posted earnings per share of like 1 or 2 cents a share. So they're being pretty strict or seem to be focused on making sure they're not burning through cash as they're scaling. And then as soon as they hit that critical mass of stores, that's just going to turn into higher and higher margins and EPS over time. So the stock seems like it's doing really well, despite the fact it's a pretty premium place to get a burger, it seems like. So those consumers obviously aren't struggling too much, where they're just doing a really good job of customer acquisition and expansion and where they're opening up new stores. But I definitely thought they deserved a bit of a shout out here given their recent performance. And then another stock here, Texas Roadhouse. Texas Roadhouse stock, 150 bucks. I feel like it was at 100 bucks and I just blinked and we're at 150 bucks here. You can see just how fast this one's taken off. In October, it was $96 a share, even lower, $91 October 12th. And here we are just about 4 or 5 months later, up 61%, almost a $10 billion company now. I believe their forward PE is about 26, trailing's at 32. They have almost no debt on their balance sheet, or even maybe no debt on their balance sheet at all when I checked a while ago, which is great in terms of being able to be aggressive in how they allocate their capital without needing to worry about debt servicing, being able to pay a growing dividend, invest in increasing store counts over time. So really positioned to play on offense as they grow this brand and grow their business here. So really great job done by them, and shareholders are definitely returning the favor to them. Sorry about that. One here that hasn't really moved in the last few years is Cheesecake Factory. So in the last year here, down actually 13%. Last 5 years, down 26%. So has been doing even worse than I thought. During the pandemic, went all the way down under 20, climbed huge to about $60 a share, and has been corrected to about $34 here. Says trailing earnings is about 20 times, paying about a 3% dividend yield. I think their earnings per share forecast is close to $3, so that would spell about a 12 times earnings multiple. But not sure if there's any funny one-time items or boosts in that, and it's really closer to historical of 20 times because I don't think they're really growing their top line to any fast degree. But this just kind of shows the difference between a company like Cheesecake Factory, and it's just kind of been stable, not too much growth necessarily in terms of their core business, versus Texas Roadhouse. Despite having a higher multiple to start with, it's just crushed it in the last year, as maybe some of that risk on goes back into favor in this space. Oh, that's not Texas Roadhouse. In this space, in the restaurant space, both between Texas Roadhouse here up 40% in the last year, and then Shake Shack as well that we were just looking at, also up really nicely in the last year, about 76%. So that is a space that I continue to watch. You know, I love the space. I love the companies that really operate on these capital light royalty streams because I think they're really attractive spaces in the market and industries, especially when the market goes down and is having a lot of headwinds or interest rates go up. I love not really having companies with high capex on their balance sheet to deal with. It's just less variables between their revenue and their net income to manage increasing costs, whether that's on labor, on rents, or whatnot. So it's a model I like a lot in the restaurant space. It's also a model I just like more broadly, looking at some of the other stocks I have here. I haven't been adding to some of these in a while, but I have Diversified Royalty Corporation here, which offers an opportunity to own royalty streams from everything from Mr. Lube, which is a car oil changing company in Canada, to Sudden Realty Group, which is a real estate brokerage, and everything in between as well. One other stock that I added on the infrastructure side, and I added pretty heavily to this in my RSP as well as my TFSA with my new contribution room, was Brookfield Infrastructure Partners. So first things first, the reason I added this in my TFSA and RSP because I believe they have a lot of complicated tax implications of owning a partnership. So I really did not want to own a share of this in my unregistered accounts. I think it's different tax filings, potentially different treatment of how those distributions are taxed. I just didn't want to deal with any of it, so I put it in those two accounts. Looking at this one in the last year, still down about 7%. So similar to Fortis and some of these other heavy infrastructure companies, as interest rates have continued to persist higher, they've really had a hard time getting back up to historical high valuations, despite the broader market moving up in a big way, mostly behind big tech. So as the market's kind of slowed down or been stagnant on these assets, I think it's a great time, in my opinion, to build this up a bit in my portfolio. Long term, would love to own this core infrastructure. Companies like Brookfield Infrastructure own toll roads all over the world. They own utility pipelines in different areas of the world, telecom assets, data center assets, all different kinds of businesses that are really key for lots of economies and lots of countries around the world to leverage. They have a lot of inflation-adjusted increases in payments on lots of these services that they provide around the world. And I believe they're trading at a low teens multiple at these valuations, in the low 40s, where I got a hold of most of my shares, $41, $42. So liked all of those elements of the company here. In the last 5 years, still up about 30%. Obviously has been a bit weak over the last 1 to 2 years with the interest rates going up as talked. But before that, they were doing a really good job of growing their value of the company as they paid a growing dividend yield. And they just increased the dividend yield another 6-7%, despite having a starting yield of 5%. So they're targeting 6 to 9% dividend increases over the medium term. They've proven the ability to do that, and they continue to display really strong capabilities in terms of creating value on the assets that they do own. So really like this stock, really like the different areas they're in terms of investments they've made in data centers, investments they've made in freight and global shipping, investments they've made in the toll roads they own, in telecom assets in India, which is really cool exposure to have. And their valuation seems extremely reasonable for me, in the low teens here, getting that 5% starting yield and it growing up from here as long as they meet their targets and obligations that they've set up for shareholders. So this is a new stock that I've added to my broader portfolio. You just won't see it here in my TFSA because of or in my unregistered account rather, because of the tax implications of holding it here. So those are some of the moves and things that I've been up to across my accounts here. Looking forward to, hitting my timeline in terms of when RSP contributions are maxed out for last year, which will be the end of February. And then I can start building in this account a bit more too, at $264,000 right now. Hopefully the market holds up well and we're able to sky closer to $300,000 in the coming months. If you like this kind of content and want to follow along for the journey, be sure to give this video a big thumbs up. Consider subscribing to the channel. Let me know what stocks you've been buying over the last few months in your TFSA, in your RSP, or your unregistered accounts in the comments below. Thanks.